Thank you, Rob. It's a pleasure to be here. Thanks for the invitation.
So I have to ask, we always start this way. How many of you are coming to the Fed for the first time? And how many of you have been here before? All right, so that's good. So we're thrilled that you're here. I'll just mention Darren Peschel, who runs our Houston branch, is one of the great leaders and branch managers in the Federal Reserve System. So we're always thrilled to be here in Houston, and I'm always reminded when I'm here of the great leadership of Darren and his team. So thank you, Darren, for having us. So Janet, it's great to have you here. Janet interviewed me when I was coming to the Fed. We worked together for my first 2.5 years. She's a great economist, a great leader, and it was just a thrill to work with her during this time. So that's why we're so glad to have her back. And so I'm going to talk a little bit, something you may not get the chance to do that much, talk a little bit about your life.
Okay.
And then we'll talk a little bit about economics. But let me start with, how did you decide to become an economist?
Well, I decided to become an economist during my freshman year as an undergraduate at Brown. I always liked math and science, and I went off to college with the thought I might be a math major. But I was fortunate to take economics during my first year at Brown, and that was love at first sight, and I never looked back. I knew that was the right thing for me, because what really attracted me to economics was the logical, analytic, sort of rigorous way that economists think about issues and look at empirical data. But it was really about things that are fundamental to human welfare. Opportunity, the ability to support one's family and to achieve one's goals, to have a secure retirement, to see one's children advance and do well. And so to have a job, very importantly, to be able to find work if somebody wants to be in the labor force. So this was a tremendously appealing combination to me. I also early on took a course in macroeconomics where I studied the Great Depression and came to understand what economists thought had happened that caused such a prolonged period of intense suffering and joblessness. And I realized that economists felt they had ways that they could address that. And if we ever had another episode in which there was a huge, significant negative shock, there were things that could be done, and we shouldn't allow a prolonged period of very high unemployment. And I guess that tied in with my own upbringing. My parents had grown up, they were college students during the Great Depression, and it had influenced their lives. And they talked to me about joblessness and what they had seen during the Great Depression. My father was a family doctor, and he took care of lots of working class people who suffered from the ups and downs of the economy. His office was in our home, and you know, I heard very often when I was growing up about what it meant to family life if someone lost a job. So this was always an interest of mine from early on. I never expected that we would have an episode that had the potential to be as serious as the Great Depression, but you know, when that happened back in 2008, after the financial crisis, this was in some sense the culmination for me of what had interested me in economics in the first place.
Okay, interesting. That explains a lot. And so you've always been known as somebody who's had a focus on the labor market.
Yes.
And is that always an intentional focus from early on?
Yes, because my interest was unemployment and macro policy to address it. Much of the research that I did had to do with unemployment and how the labor market functions, and that was always my interest.
So you were an assistant professor at Harvard, and then you went to the Board of Governors.
Yes, I did.
For a year. What brought you to the Board of Governors of the Fed?
Well, like many assistant professors, I did not get tenure at Harvard. And I was very attracted. I considered where to go next.
Yeah.
The Fed had actually the board had tried to recruit me when I was first in the job market. I'd been offered a position in the International Finance Division at the board. I knew quite a few people there, and I thought very highly of the work that they did. So when I left Harvard, I thought right away about coming back. I liked very much the combination of strong research ability and focus on research and the application to policy.
Okay.
And that was my interest. Now, you said I only stayed there a year. I intended to stay there for a very long time.
Yeah.
I thought I would be there over the long term. But one day, after having been there for only 4 or 5 months, I went to a seminar, and we took the seminar speaker to lunch up in the board cafeteria. And so many
Same
people...
cafeteria.
Same cafeteria,
Yeah.
under reconstruction
Yeah,
at the moment.
right.
But we went to the board cafeteria, and there were so many people who wanted to sit with the seminar speaker. I couldn't get a seat at the table, and I went to an overflow table where there was just one other person who was a visitor, a year-long visitor from Berkeley.
Yeah.
And he and I started talking, and it turned out we shared very similar interests and backgrounds. And so I think that was just before Thanksgiving
Yeah.
of 1977. We got engaged just after New Year's.
The cafeteria, same cafeteria under construction.
Cafeteria.
Wow.
And
Who knew?
we got married in the following July, and my stay was cut short. We went off to the London School of Economics, and I later got a
And then
job
to
at
Berkeley.
back at Berkeley.
And you
so
were a professor at Berkeley for many years.
many years, yes.
And so then you went back and became a governor.
Yes.
And how did that happen? How did you get that opportunity? And what made you decide to go back and do that?
Well, so I'd always been interested in macroeconomic policy, and the mentors that I had, James Tobin at Yale and Arthur Okun and others, I had always been interested in combining research and an academic career with stints in government, being involved in macroeconomic policy, monetary fiscal policy, and other things. So the notion of working at the Council of Economic Advisors or at the Fed,
Right.
this is something
Made sense.
I always wanted to have as part of my career. Now, I didn't have any experience in government other than that brief stint
Yeah.
in the International Finance Division. But one day, the phone rang. Actually, I was on vacation in Hawaii at the time. I was on sabbatical.
Yeah.
And my spouse and I were doing research together, and we'd gone off to a vacation in Hawaii. The phone rang, and it was someone from the Treasury asking me if I was interested in, so I guess this would have been 1994.
Right.
Was I interested in potentially serving as a governor? And the person complained that I was very hard to get in touch with, and they had almost given up. And when I got back to Berkeley and I played my answering machine tape, I saw that had been a sequence of calls. The first said, "This is someone at the Council of Economic Advisors." The next one said, "This is so-and-so from the White House. Could you please call this number?" And there were a string of these messages.
Yeah.
And, I was a professor. I was on sabbatical. I went off on vacation. People didn't have cell phones. They didn't have pagers. And I didn't leave any indication of how anyone could get a hold of me.
Okay.
So I almost missed this call. It turns out that a friend of mine was chair of the Council of Economic Advisors at the time, Laura Tyson.
Sure.
And they went to Laura and said, how can we get a hold of this woman? And she said, well, we have the same travel agent. And
So for those of you who wonder how things happen, this is how they happen.
so fortunately, our travel agent knew where we were,
Okay.
and they got a hold of me.
So you became a governor.
I became a governor.
Fun?
Very interesting, yeah.
This is pre-Paul Volcker.
Well, Greenspan
Greenspan.
was chair.
Yeah.
I was
Pardon me.
I
Yes.
was
Pardon me.
confirmed,
Paul Volcker. I should say.
and I think August of 1994 was my first
Yeah.
meeting. I didn't know Greenspan at all.
Yeah.
And this was a period when the Fed was beginning to raise rates.
Right.
The first rate increase had been in February of 1994. It's hard to imagine this now, but once upon a time, the Federal Reserve never even announced when they had decided on a policy change. And February 1994, which was the first 25 basis point increase in the Fed funds target, came after a long time of the funds rate being held at 3%. Alan Greenspan insisted that this had to be announced, that he didn't want the markets to discover it because they were seeing what was happening in the money markets,
Right.
which was how people previously discovered what was going on. That was the first time the Fed ever even announced that it had made a decision to change the policy rate. And of course, as you know, communications has evolved a lot.
Yes.
But I was involved in that
Yeah.
tightening cycle.
Yep.
My first meeting in August, we voted to raise rates 50 basis points.
Yeah. Which would be unheard of today.
Unheard of. In November, Greenspan proposed a 75
Oh,
basis
man.
point increase. I believe the largest single increase in any meeting. I knew that President Clinton, who had appointed me, was very concerned about the economy.
Yep.
But, I was looking with others, including another colleague, Alan Blinder, who had been appointed at the same time. This was an economy that was really hot.
Yeah.
And inflation was still too high.
Tech boom
and
in the early stages. Yeah.
It seemed like the right thing to raise interest rates, and we went along with that. And some further interest rate increases later in the year before we began to feel enough's enough.
Yeah.
And Greenspan agreed. But it was a challenging time and a real learning experience for me.
You went from there to the Council of Economic Advisors. How did that happen?
One day I was minding my own business.
Working at the board.
Working at the Fed. Finally, I guess this must have been late 1996. So I'd been there for 2 years. I was finally beginning to understand what I was doing and get the feel of, as you know, there are a lot more people know about monetary policy, but the Fed does many more things. And for me, all those other things were a big learning curve.
Yep.
And I was finally getting up to speed and beginning to feel like I was becoming more in the positive column
Yep.
rather than the negative column in terms of contributions. And the phone rang, and it was someone from the White House asking me if I'd consider chairing the Council of Economic Advisors. And it wasn't a job I was really looking to do,
Yeah.
and I actually found the thought of doing it quite daunting.
Yeah.
Because the Council of Economic Advisors deals with absolutely everything pertaining to economic policy, including many things that were I felt to be outside my expertise. And I immediately went to Alan Greenspan because he had served as chair, and I asked his advice. And Alan said, "This is an offer you cannot say no to. You have to go do it." And that was the advice that I got from a lot of people. So I wasn't looking to leave the Fed, but I did go and do it. And I mean, it was an immensely interesting experience, and I stayed until the summer of 1999.
So then you made an entry. Ultimately you went back to to Berkeley.
And then I went back to Berkeley.
And then you did something, interesting move. You went to run the San Francisco Fed. You went to become a Federal Reserve Bank president. I've heard of it going bank president to the governors, but I haven't heard of it going. I assume it's happened, but I can't think of a lot of examples.
I'm not positive if that's happened. It probably has. I should know the history.
So how did that happen? You took over in 2004, running the San Francisco Fed.
So I very much enjoyed my Fed experience and welcomed the opportunity to return to the Fed. Bob Parry, who had been president of the San Francisco Fed for, I think, 17 years, reached retirement age and stepped down. And I received a call from the head of the search committee in San Francisco asking me would I be interested. And I enjoyed being back at Berkeley and doing academic research and teaching.
I assume you didn't have to move.
I didn't have to move.
That's great.
Stayed in one place. And I thought it'd be interesting in a different way of participating in the Fed, and that I'd learn a lot. And I welcomed the opportunity and said yes. So
from there to then asked to be vice chair, and then ultimately we all know to become chair.
Right.
And I guess the question I'll ask, we'll start with being chair. What are the one or two most important things, adjustments you had to make after all that experience in becoming chair of the Fed? Well, serving as chair of the Fed is a leadership role in an important organization. And while everybody who serves in leadership positions at the Fed, I'm sure, feels the obligation to establish a set of values for the organization and to motivate the people in the organization. What is it that we're doing? Why is it important? What are the core values of our organization? That is something I felt very strongly as chair, that I wanted people to understand what we are about as an organization, that our job is to make sure that we have a financial and economic system that works to promote the well-being of Americans, and all the work that we do, whether it's in bank supervision or financial stability or the payment system or community development or monetary policy or IT, it all ties in with those important goals. We're an organization devoted to public service. We are professional, and we make decisions based on facts and evidence and analysis, and we stay out of politics, and nothing we do is political. So that was, I felt, a core responsibility of being chair. Then, of course, you know, Rob, the chair it's actually a separate appointment to be chair of the Federal Open Market Committee. I suppose the committee could actually choose another individual to be chair other than the chair of the Board of Governors, but that would be an unusual thing. So chairing the FOMC is a key responsibility. And, you know, as you know, chair of anything is a person who helps set the agenda, prepare meetings, work with the staff to make sure that the information and analysis is available and distributed to the committee members to enable productive discussions, and to make sure that decision-making is orderly and collegial. And I felt a core responsibility of the chair is to try to find consensus about policy. I think a strength of the FOMC is that there are many different opinions around the table, people coming from different backgrounds with different perspectives who make different contributions. And I think that falling into groupthink is a danger for any organization. And so it's very worthwhile to have a range of views around the table. But at the end of the day, for an organization to succeed, you need to bring people together
behind a strategy and decisions and a way to communicate that to the public. And so I saw that as a core responsibility. And then communicating what is policy and what is the rationale for policy to the public, whether it's in speeches or press conferences or congressional testimonies. I thought that is another core responsibility of the chair, and to make as clear as possible to the public what are the values that motivate this organization, why are we doing the things that we're doing, what are the goals. In monetary policy, it's easy. It's price stability and maximum employment, our dual mandate, and explaining how the decisions we're making relate to the attainment of those goals.
So people forget where we're sitting today, but when you took over, still unemployment was stubbornly high. Inflation, although had picked up closer to 2%, it was still wasn't running away from us. We had done several rounds of quantitative easing.
Yes.
New territory, hadn't been done before. But we ultimately went for 8 or 9 years before we got to the fall of 2015, before we finally raised the interest rate. And I was in those, I joined a few months before in those early meetings, and there was a lot of fear, which you might want to speak to, about we don't want to be raising the rate and then having to make a return trip back down.
Yes.
Why was it so hard, do you think, to ultimately start the process of normalizing monetary policy?
Well, the recovery seemed fragile. When I started as chair in 2014, unemployment was still, I think, 6.7%, and it was dropping but slowly.
Yeah.
If the economy were to falter, our tools to deal with that were not impressive. We had our feet pretty firmly planted on the accelerator, giving the economy all the gas we could. We had had $3.5 trillion worth of asset purchases. By the time we raised short rates, they had been at zero for 7 full years. We had offered forward guidance. We'd done about everything we could think of doing to get the economy moving. And if we made a mistake and the economy weakened, and there were constant external shocks. I remember that at the time we were about to start raising rates, and we were thinking quite seriously about doing so in September of 2015. China devalued its currency. There was a weakening of the global economic outlook. There was financial market turmoil and tightening of U.S. financial conditions, and that posed downside risks to the U.S. outlook. We knew that if inflation were to take off, and again, we were coming from a position of 6 or 7 years of inflation below our 2% target. If inflation were to take off, you know how to deal with that. We had plenty of room to raise rates or sell off assets or tighten policy. But if the economy faltered, we're doing everything we could. So the risk seemed asymmetric.
Yep.
And I think it was my judgment and that of most people on the committee that we need to be very careful. And our foot was really on the accelerator. The economy seemed to be recovering. It seemed like it would be appropriate to begin to move toward, let me just call it a neutral setting, at least more in the direction of something neutral as the economy was able to perform on its own without so much help. But I thought it was very important to do so in a very careful way.
And people also forget, while we raised rates that December, then these issues with China you mentioned sort of reached fruition again, and we didn't raise rates again until a full year later.
Sometimes people these days, they talk about the committee's projections, and as you know, you come out of a meeting where you've issued these projections, and people look very much at the median, and act like, oh, the committee is agreed they're going to raise rates twice
Yeah.
this year. Well, go back to 2016. We raised rates for the very first time off zero in December of 2015. When people filled out the survey at that meeting where we first raised rates, they anticipated 4 increases in 2016. Again, there was weakness in the global economy after our
And I
first
think that's what I wrote down
rate
also,
increase.
by the way, yeah.
I probably did too.
Yeah,
And
didn't work out that way.
by March, the median was down to 2, and we actually raised rates once.
Right.
So, I think that indicates that, look, having my own fingerprints on these projections, which come under a lot of criticism, I thought that was helpful information for the public. But, of course, monetary policy plans are never set in stone.
Right.
And there's a lot of uncertainty that each individual feels about what will happen with the forecast, and things are constantly reconsidered.
So you might comment, while we were doing that, there was also historic effort on macroprudential policy, on regulatory policy, particularly stress testing, very tough capital requirements. How essential was that to what happened? And what's, I guess I'll bring it today, how do you feel about some of the streamlining, other efforts to modulate that somewhat?
So I feel very strongly that we needed to strengthen the financial system substantially and to do everything that we could to avoid another financial crisis. And I have always been strongly supportive of the agenda of stress testing, more capital, more liquidity, many other things. Safer derivatives markets, money market reform, resolution planning, the whole 9 yards. I know, having voted for hundreds of rules and thousands of pages of rule writing, that undoubtedly there are some things in those rules that created burdens for banking organizations that needed to be revisited. And some rules, like perhaps the way the Volcker rule was implemented, that may have had unintended negative consequences. And so I have not been opposed to, after a decade of doing this, to going back and revisiting the rules, trying to refine them so that they're less burdensome and avoid or remedy unintended consequences. But I am very concerned about pushing that too far. And the deregulatory fervor.
I assume particularly for the big banks.
Particularly for the biggest banks, yes. But, there is kind of, people are tired of regulation. And I fear we could be in a cycle where deregulation goes too far.
Right.
And there are things that have happened that greatly concern me. So there are ways in which I feel deregulation has already gone too far. There's also an unfinished agenda of work. We made a lot of progress. I feel the financial system is much safer, but there's still an agenda of financial stability work that needs to be done. For example, we insisted that derivatives, all standardized derivatives, be centrally cleared on exchanges. That arguably improves the safety of the derivative network. But we've created another set of systemic institutions, the central clearinghouses, that also need to be appropriately regulated. and I would say that's a work in progress. And there are other things
Okay.
in that category. So, yeah, we worked on this for a decade, but it's not time to call it quits. There's unfinished work. And yes, adjustments are in order, and many of them are appropriate, but in some places I think things have gone too far.
And I'm going to follow up on that in a moment. Let me ask you, though, bringing forward today, one of the issues we're dealing with now, obviously the Fed funds rate is at 2.25%, 2.5%.
Yep.
So it's come a long way. 9 increases, including that first one in December of 15 that we just talked about. We've got global growth decelerating.
Yep.
We've got a fair amount of trade uncertainty.
Yep.
And obviously some trade activities that are new, which may be in combination with global growth decelerating.
Yep.
How does that factor into your thinking about U.S. economic growth and the impact that might have on monetary policy?
So, I mean, as an outsider now looking at
Yes.
how you and your colleagues
That's correct.
are managing things,
That's right.
I give you an A at this point.
Okay.
I mean, I think you're in a good place. You know, 2018 was a strong year in terms of growth, coming in at basically 3%. But everybody wishes that our economy could grow in a sustainable way at 3 or 4 or 5 or more percent. That would be a wonderful thing, but you know, unfortunately, given slow labor force growth and relatively weak productivity growth in the United States, you and your colleagues place the median longer run growth rate of the U.S. economy at just under 2%, and
Yeah, that's
that
where we are here in
coincides
Dallas.
with my view. So I think my sense is we have a good, strong labor market. You know, maximum employment, maximum sustainable employment is a goal for the Fed. I would judge the labor market to be in a state that is a full employment labor market, essentially. And you don't want to, although inflation is quite low, and I see the inflationary process is in many ways very benign, given that inflation expectations are well anchored, and the links between the labor market and inflation, the so-called slope of the Phillips curve, it's flat, that's a weak link. I wouldn't be worried about inflation, but if the labor market were to keep tightening, getting further and more tight from where it is, I would worry eventually that creates an inflation risk. So for all the reasons you gave, slowing global growth, uncertainty about trade, less impetus from fiscal policy, some tightening of financial conditions, global U.S. growth is slowing, and the median FOMC forecast of vicinity of 2 or just a tad above.
Yep.
That looks right to me. That's within spitting distance of a sustainable growth rate for the economy. So with inflation well contained, around 2 or a tad below, and growth more or less at trend, you know, it seems to me that monetary policy is well positioned. Mm-hmm. There are a lot of uncertainties, both on the upside and the downside. There are global growth risks. If they were to intensify and the outlook weakened, maybe at some future point, you know, you might decide it's appropriate to cut rates. I wouldn't see that myself as appropriate at this point, but watchful waiting, patience, watching how the outlook evolves, and being open to the possibility that it could weaken and cuts could be in order, or alternatively, inflation may pick up more than you expect. I don't think that will happen, but it's a possibility, and be positioned to
But we're well
move
positioned here for
either
either.
direction.
Mm-hmm.
This this is how I interpret where you are, and
Yeah,
it
that's a good interpretation, I think.
seems a sensible
All
place
right.
to me.
So let me ask you two other quick questions, and we're going to open it to the audience. Number, you have mentioned, we wrote an essay here at the Dallas Fed. I wrote one a few weeks ago, but you've also commented publicly your concerns about the record level of corporate debt to GDP and the concerns you'd have about the implications that could have. I've called it an amplifier in a downturn, but you've also raised similar concerns. We're not the only ones that have. Tell us a little bit why you raised those issues.
Well, so my concerns are very similar to yours. I don't think this will cause the next downturn, but I would agree, and I like your term amplifier. I think that if there is a recession in the U.S. or a downturn in the economy, that we have tremendously high debt levels of many non-financial corporations, particularly those that have lower credit ratings. And I think the protections, the normal protections that you would see in corporate debt like this have really eroded. I guess you could call most of this covenant light, but when you start delving into the details about the covenants that have eroded, the erosion to my mind is quite serious.
Yeah.
So I believe the losses on much of this debt could be far higher than people are accustomed to.
Mm-hmm.
I've been concerned about this for quite a long time. I gave a speech as vice chair about trends in leverage lending and saw similarities to what was taking place with subprime lending in the run-up to the financial crisis. So weak underwriting standards, risky loans, loans being packaged into, in this case, CLOs, being carved up and sold to investors who potentially didn't understand the risks. And I thought it was appropriate for the Fed and other regulators to adopt policies that would constrain some of this lending. It took a long time to do anything. Ultimately, the Fed issued supervisory guidance.
Yeah.
It was, frankly, less than what I personally would have regarded as appropriate. And while it had, I think, an effect at containing some of this for a while, ultimately, there was a big pushback against this guidance, and it's no longer really, at least my sense is, having very much effect on this practice. Now, if the holders of these leverage loans and the CLOs were highly levered themselves,
Right.
I would worry more about this
Yes.
than I do. My sense is that it is mainly real money investors, pension funds, insurance companies, and other investors who are not leveraged who hold this.
Right.
And my sense is also that the exposure of the banking system to these risks is much smaller than in the case of subprime lending. Also, to the extent that it's there, we're probably monitoring it and capturing it in the stress test for the largest institutions. But, there were rules written in Dodd-Frank to require so-called skin in the game for packagers of loans, because one of the problems with subprime lending is banks and other entities packaged loans and sold them into the market, and they didn't hold any of it themselves, or often they didn't hold these investments themselves, and their incentives were skewed to to not appropriately take account of the risks that they were putting on investors. So Dodd-Frank required skin in the game. And the rules that we wrote applied to packagers of CLOs as well.
Right.
But then that was overturned by the courts for, I think, a technical reason, probably valid, but a technical reason. So you still don't have skin in the game when
Right.
it comes to this kind of leverage loan and the packages that
So your advice to
they're
the
put
Fed on
into.
this would be what? At this stage, should we be tougher from a supervisory point of view than we are?
Well, I think it points to a hole in our financial system and the approach that Dodd-Frank took, which is, I think when there are practices that create risks to financial markets and financial stability, but may not create safety and soundness concerns for individual banks, we do not have the tools in the United States to, regulators don't have the tools to address such risks. So if this was a safety and soundness concern for the banking organizations we supervise,
Have tools.
yes, we have the tools. But to the extent this is being sold into the market and creating risks, I don't see that we do have the tools.
Right.
And to the extent that some of this is being originated outside the banking sector,
is,
in
yeah.
the shadow banking sector, again, I don't think we have the tools. So I would say this is a financial stability concern to me.
All right, I'm going to ask you one question before, and we're going to, you might, if you have questions, we have 2 microphones on the sides there. It may be cumbersome for some of you to get to, but please feel free. And I'll ask you, I'll say an interesting one for the last one, at least this part of the program. What does Fed independence mean to you, and why is it important? You knew I had to ask you this, so forgive me.
Well, I think Fed independence is very important. It's not goal independence. The Fed's goals are set and established by Congress. So to me, independence means that the Fed should have the ability to use its tools to decide what is the best way to achieve those goals, and that's something that should not involve politics and that Congress should not be able to overrule. And those decisions should be made by a committee that is governed by a congressional mandate. It makes its decisions based on best technical analysis, judgment, information, analysis of risks in a completely non-political way. And I believe that's exactly what the Fed does.
Yeah. That's been my experience.
And I strongly support it. And there's a large body of research that shows that in countries with independent central banks, macroeconomic performance is better. So I strongly support it.
All right, please.
Good evening, Dr. Yellen. Welcome to Houston. My name is Ronald Joe. I'm with Frost Bank. As a follow-up on that, your comments, which I completely agree with, what would you do if you were still Fed chairman and say, 1 or 2 bankers were appointed, 1 or 2 governors were appointed whose policy prescription seemed to be driven by nothing but politics? How would you handle that?
So, it's a president's right to nominate people to the Fed board, and the Senate's obligation to carefully review and judge their qualifications. And I would hope very much that the Senate would take that responsibility very seriously to put qualified individuals on the Board of Governors who can make a contribution and respect the independence of the Fed as an organization, which it is something that Congress has created and supported. That's something that has been created by Congress. Now, if,
So you would trust the process to start with?
Yeah, I think, as I said, I think having a range of views in a committee is a healthy thing. You don't want to have groupthink. It's important not to have everybody think about the world exactly the same way. But I think given the culture of the FOMC, what individuals would find who joined that committee is that the discussion is based on facts, analysis, and disciplined discussion and analysis of options, and people push one another. You know, it's a polite conversation,
Yep.
but people listen carefully to what other people say, and if the arguments that people make and the evidence they bring to bear are not well-grounded and thoughtful, over time, people sitting around that table will challenge their colleagues on the relevance and appropriateness of what they've said. I think,
And I will attest to that.
you know, it's
It's great. It's a great meritocracy in that way.
right. And so, in that sense, I think, individuals will find it difficult. A couple of individuals will find it difficult who come with a political view to have a great deal of influence.
Okay. So let's try to sneak in a few more. Here we go.
Yes. First of all, thank you, Professor, for your service to our country and
Thank you.
obviously to the Federal Reserve. If I could step outside the Federal Reserve policy for a second, for those of us who lived through the fall of the Soviet Union and Mao's China, we've seen the destructive influence of socialism and communism, writ large across the 20th century and on into the 21st century with Venezuela. Not from a political standpoint, but from an economic standpoint, what can we do as people here in this office and certainly the Federal Reserve and others, what we can do to, we're seeing the rising specter of socialism again. What can we do to help, try to help people see that the free enterprise system, which has given us so much, is in fact, the appropriate system to continue utilizing for this great country?
Well, personally, I feel strongly that a market-based economy and capitalism is the most successful system. I think most people in the country share that view. Now, there can be market failures. There are market failures of various sorts, and I think it's appropriate to have government intervention to make sure that the market economy works well and promotes the well-being. We have an appropriate social safety net, but I think that this is a widely shared value in this country, and certainly the Federal Reserve is operating, trying to put in place policies that promote the best performance of the economy, whether it's monetary policy or supervision and regulation, to make sure we have a financial system that works but is a market-based capitalistic system.
Thank you.
Thanks for being here. I appreciate it. Two quick questions.
We're going to take one because I just want to we've got a number of people waiting.
Okay. Well,
Thank
now
you.
I have to determine which one's more important.
Sorry about that.
So I guess I'll go with the first one I was thinking about. So we've had an incredible amount of economic easing, especially with, the quantitative easing, the tax cuts and everything that we've done to kind of push the inflation envelope a little bit. And you're saying that it's the employment situation that actually worries you the most as far as like pushing the inflation numbers that actually push inflation. Is there anything else that you see in the system that can start pushing the inflation rate above the target rate? Because we're just really not seeing anything currently that's really kind of giving that extra oomph to more inflation within the system.
Well, so the Fed's inflation target is 2%. Of course, it's a symmetric target, and sometimes it's below and sometimes it's above, and that's normal to be expected. The problem, I think, is that we've had 6 or 7 years in which inflation is running under 2%. Recently, inflation has been quite close to 2%, core inflation, excluding food and energy, has been over the last 12 months running about 1.8%, but it's pretty close to 2%. So, to my mind, inflation has moved up. There are a variety. It's important that the Fed achieve its 2% inflation target. If the Fed were to treat, and I think some people misjudge the Fed on this, some people seem to think the Fed is happy as long as inflation is under 2%. The 2% is a ceiling rather than a target. That is not the Fed's view. That is a dangerous view. It's a view that, if it were widely held, would probably lead inflation expectations to drift down over time, which would be very worrisome in a low inflation environment. But to my mind, I see the economy operating at basically full employment, with core inflation awfully close to 2%. There are other factors that influence inflation and can have a significant effect, and have had a significant effect over a number of years. Movements in energy prices, which have by and large in recent years been holding inflation down, and other factors like an appreciation of the dollar that tends to push down import prices. But I see going forward, my own forecast would look pretty much like the FOMC's, that in this economy, with growth around running around 2%, if it turns out that way, and a labor market that's quite tight, I would expect to see inflation in the neighborhood of 2%.
And that's our Dallas
I think
Fed
that's gonna push
forecast
it.
also, 2%, end the year at 2%. Sir.
Thank you for being here in Houston.
Thank you.
In regards to unemployment, your target, what do you factor in for the underemployment, the contract labor, the gig economy, the multiple jobs to try to come to a full-time job? It seems like there should be some adjustment in what that target is as a result of really those jobs aren't the ideal jobs that the people are looking for.
Well, the unemployment rate is the single most cited statistic, but there's no specific Fed target for what the unemployment rate should be. It's whatever looks to be consistent with stable inflation in the neighborhood of 2%. And I think for many of the reasons that you have cited, estimates of what measured unemployment rate are consistent with stable inflation have moved down a great deal over time. So one factor has been involuntary part-time employment, which was coming out of the crisis quite elevated relative to the normal unemployment rate, suggesting that, of course, broader measures than the normal unemployment rate show more slack in the labor market than the narrow so-called U3 or civilian unemployment rate measure. But they tend to move together. But sometimes other statistics, like the ones you're citing, suggest really there's more slack there than you would judge by the unemployment rate. And it's paying attention to trends like that I think has led committee members over time to lower their estimates of what measured civilian unemployment rate is consistent with stable inflation. That's come way down. I think even when we were starting to raise rates back in 2015, I believe the committee's estimate was around 5%. What's it down to now, 4.1 or?
It's 4.1 is the latest, and it wouldn't surprise me if it came down a little bit more.
So, looking at how the labor market is performing, how wage and price inflation are behaving, this is something that's constantly revised for the reasons you've given.
Thank you.
Yes, we'll take this lady right here.
Thank you so much for being here,
Thank you.
Dr. Yellen. So I loved hearing about your career and how it advanced. I'd like to ask some questions about, one question about, one question about your career trajectory and participation in the economy and the success for us all. I heard that, you were tapped several times by male mentors who recognized your strength and your knowledge, and that's a really, really hard thing to do. I was, quite frankly, very surprised when I entered the professional world. It did feel easier to understand what the rules were, and seeing how you've navigated things. I'm sure you've walked into a room and been the only woman, and we're in Houston, the most diverse city in the country. We actually have a plurality of Latinos, and we're trying to have everyone participate. You talk about consensus and consensus building. How were you able to build consensus and trust and help to get the best policies out there? And what's your advice to men in the world in this room, who are scared right now because of the Me Too movement, and getting them feeling comfortable about having a mentor or a mentee who might be different than them?
Well, let me just say, I strongly believe in diversity and inclusion, and tried to make it a very high priority within the Federal Reserve, and something that all the senior leadership, including me, were involved in a regular basis in promoting. I was very fortunate to have male mentors who cared about my career and gave me good advice. Often, I think women, the kinds of barriers that women face in succeeding, it's important for them to have female role models and the availability of female mentors. And I think that, again, that's something that in economics and in organizations more generally need to attend to. I think that can be very important to success. Looking at it, in academia, in the Fed, in business and finance, you see that the further up you go in the hierarchy, the lower is the representation of women, and trying to understand what are the barriers that make it hard for women to succeed, and trying to address those barriers. Work-life balance is also an important barrier for many, many women, and I think particularly in businesses and in finance, where there's an ethic of you need to be available 24/7 to deal with whatever comes along, makes it extremely difficult for women to achieve a reasonable work-life balance. And I think this is something that organizations need to be really attentive to. I'll just say, I think diversity and inclusion has become a more important goal. And while you said I must often have walked into rooms where I'm the only woman, that is very true. Central banking, especially at the highest levels, I believe that under 10% of central bank governors are women, and the numbers have actually declined over time. Again, I'd never found a hostility toward my being part of it, and on the contrary, there are lots of male members of that world that really want to promote the success of women, and there are more women when I go into these rooms. They may not be at the main table, but there are more women in the back benches, and making sure that we attend to their succession and opportunities, so that they can end up at the table in the years ahead, I think is important.
Jason Leader, President Kaplan, thanks for hosting this great event. Chairman, Chair Yellen, thanks for coming to Houston. Actually, my question is more on what your comments on inflation symmetry. So you were mentioning how inflation was running cooler than the 2% target for about 6 or 7 years. So in symmetry, from your perspective, does that also mean that inflation would run above that for 6 or 7 years, or is it more the magnitude of the inflation overage, or is it more time, duration? I mean, how do you think of that?
So I would say at the moment, the policies, the Fed back in 2012 adopted a statement about its goals and strategies. And if you read that document, it essentially says that the Fed's objective, what it considers an ideal inflation rate at any time, is 2%. And so in some sense, that is always where the Fed would like to be. There are two goals, not one. There's a price stability or 2% inflation target and maximum employment. And sometimes there are trade-offs among these goals. So it's not a single-minded focus on inflation. But the idea is that 2% is ideal. There's no notion in the current strategy statement that the Fed has that has the notion that if there's been a long period in which inflation is undershot 2%, that there would then be an attempt to compensate for that by running inflation above 2%. So my understanding, and Rob may want to chime in on this and may not agree with me, but my understanding of the current thinking that's embodied in the Fed's strategy is 2% ideal. Symmetry means, of course, sometimes we're above, sometimes we're below, and an undershoot is just as significant and worrisome as an overshoot. And in that sense, the losses are symmetric. But it could be that the current system has problems, and it might be beneficial to rethink whether or not the current system's ideal and to consider a system more like the one that you're describing, in which if there were a long undershoot, that yes, there might be a conscious attempt to want to run inflation a little above 2% for a time so that at least loosely on average, inflation averaged 2%. And I think this is one of the things that the Fed will consider and discuss in its communications review. Let me just indicate why I personally think this is very much worth considering. Look, so we seem like we're in a world where interest rates are likely to stay low. Most economists believe that the general level of interest rates is going to be lower in the future than it has been for most of the post-war period. And Rob and his colleagues have a median of something like longer run normal short rate of 2.75%, which post-war period US, it would have averaged over 4%. Okay, that means that there's not that much room to cut interest rates if there's a negative shock to the economy. And it means that the Fed can be short of tools, and all too frequently, if there are negative shocks, they're going to find themselves lowering interest rates to zero and then having to consider unconventional policies. And in those episodes with weak economy, inflation is likely to fall below 2%. Now, if in the other times when the economy is completely normal and the Fed can achieve, on average, its inflation target, if in those times the Fed achieves 2% on average, but then there are significant times when inflation's under 2%, market participants are going to say to themselves, what inflation rate should I expect over, say, the next decade? Well, some of that decade will have times when inflation averaged 2%, And then there'll be the zero bound periods when it fell under 2%, and that doesn't seem like a 2% average. That seems like a less than 2% average. And if that's the case, if inflation expectations fall, the average level of inflation will fall. And that's a dangerous situation. And then the average level of interest rates will fall even more than it already has. And this is a problem I think Japan has suffered from, and we don't want that to happen here. So the type of system that you described would be one way to address it. And it has pros and cons, and my guess is that Rob and his colleagues will be discussing that.
And just to be clear, I agree with everything Chair Yellen said. So we don't want to run persistently below or persistently above 2%, and we'd like to center around 2%, number one. We do not have a concept right now, as Janet was saying, of a catch-up. We are in the middle of a policy framework review, and we've got very notably a meeting in June, and we'll be spending a good part of this year on that framework. And some of the things you may have read about, whether it's nominal GDP targeting or price level targeting or other methodologies that might account for maybe changing inflation expectations, maybe providing for some type of catch-up. We haven't made any decisions, though. I'm open-minded about it, but we're debating it. And the reason this debate, we're even having it, because you may say, my Lord, we're at 3% unemployment rate, we're at about 2%, a little bit below, seems pretty good, what's the problem? And one of the things we've learned in history is you don't want too much inflation, but you also don't want deflation, and you don't want too little inflation, and that can be just as pernicious. And so the reason we're having this review, one of them for all the reasons Janet said and others, we want to just make sure that in the years ahead, given as was said, rates may be lower than we're historically accustomed, that we have a balance on inflation. So that's what we're working on this year. Okay, I'm sensitive to the time, yes, and I'm getting I'm going to take one more question here, then we're going to wrap up, if that's all right. Okay, yes.
Thank you so much for the additional time. My question is about the bond markets. I know there's a growing disparity between the supply and the demand that's out there. So wondering, is there any chance that y'all will bring back something similar to the Build America bond? I have a lot of conservative clients who want somewhere to park their money, but they don't want to be in the market. So they would be I know you're kind of, they would be very appreciative of that.
So I'll put it this way. Right now, the Fed has a portfolio of mortgage-backed securities and Treasury securities. And we're working to run that portfolio down to some smaller footprint. We right now explicitly, and many people have said, and I have said, it'd be better if over time that portfolio was mainly made up of Treasury securities. And we have explicitly avoided buying other types of assets or being what some might call an extension of fiscal policy by saying buying Build America bonds or others. And in fact, Charlie Plosser, very famously, I hear him ringing in my ear, have famously warned that we need to be very, very careful because if Fed independence is important, if you start lurching into that, it might threaten the monetary policy role in independence. So no, we aren't considering that. We don't do that, and we've been very strict in trying to keep a portfolio as it is and run it down with the hope over the longer run it'll be primarily made up of treasuries. So let me just close in this session. We thank you so much for being here. There's a lot of misconceptions about the Fed, and you and I have talked about a number of them. If you had to leave a message, though, for this audience, and one of the reasons we do this and live stream it is to create more understanding in the public of the Fed, what would be a message you'd want to leave about the Fed or people to walk away from thinking about the Fed as they leave this session tonight?
Well, I'm very proud to have spent such a significant portion of my life with the Fed, and I would hope that all Americans would understand that this is a well-functioning organization that is devoted to public service and making our financial system and our economy work well to the benefit of all American households and businesses, and that it is filled with ethical people who act with integrity in a non-political way to make decisions based on solid analysis, the best possible assessment of evidence, and a judicious weighing of risks. And it is an an organization that is an asset to America.
I am very grateful, and we're all grateful that you have been such a great leader of the Fed, a great leader in our country, and we're honored that you're here tonight. Thank you for your great leadership.